BHP is once again the largest company on the share market as resource stocks surge and banks fall back. Auction clearance rates take a tumble, and the very biggest super funds get bigger. Welcome to Fear and Greed Daily Business News for people who make their own decisions. It's Monday, the 30th of September, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, the main story this morning, resource stocks are surging on the back of last week's stimulus from Beijing, with BHP once again the big Australian taking the top spot on the ASX 200 from the Commonwealth Bank.
It's been an incredible turnaround over the past week. It started with Beijing promising lower interest rates and other stimuli to help the struggling economy. That triggered a surge in commodity prices, and iron ore prices topped the $100 a tonne mark in Singapore. That sent the shares of the big miners higher. For the full week, BHP closed up a massive 13%. Rio Tinto jumped 15%. Fortescue Metals Group rose 17%. The Aussie dollar is a commodity currency, so higher commodity prices, particularly iron ore and coal, pushes up the currency. It finished the week above 69 US cents, about 7% higher than where it was at its low early last month. The rotation of miners out of banks has been stark. In the same period, the last 5 trading sessions, Commonwealth Bank is down 7%, National Australia Bank's down 6%, Westpac 5%, and ANZ 4%. In fact, the rotation has been so sharp that on Friday, BHP regained the mantle of biggest company on the ASX, worth $227 billion, while Commonwealth Bank now comes in at number 2 at $225 billion. Rio Tinto and Fortescue Metals are now the 10th and 11th largest companies on the bourse, pushing Woodside and Telstra down the pecking order.
Bonus points for the use of the term stimuli.
Thank you.
Sean,
Thank you.
Yeah, makes us feel very educated to begin the week.
Yeah.
The big question, I suppose, is this going to last? Will the rotation out of banks into miners, is this actually the way it's going to be for a while?
It's a very good question. It depends a bit on whether you think what Beijing is doing will last. It also depends on when you think interest rates in Australia will start to fall. No doubt the banks are very expensive on a historical basis at least, and there is more value in some commodity stocks. AMP chief economist Shane Oliver says the risk of another correction in shares remains high given stretched valuations, optimistic investor sentiment, the still high risk of recession in the US and Australia, and geopolitical risk around the US election. On the flip side, the success in getting global inflation down, ramping up central bank policy stimulus. Nearly 50% of global central banks are now cutting rates. The Reserve Bank is closer to joining in, even if it's not there yet. China seemingly moving to a whatever it takes policy stimulus. They're all very positive for shares on a 6 to 12-month horizon, particularly if there's no recession, Dr. Oliver says. That was a lot of words to say, don't know what's going to happen. However, this is a very good segue into the interview after the show, Michael.
You are absolutely right. It's a fantastic time to be talking markets, isn't it? And your guest today is Matthew Kidman from Centennial Asset Management.
And I asked him whether this rotation will it last. And Matthew has some very interesting points on that. We talked to him about why the banks have been sold down, why the miners are doing well, and what about some of the other sectors? What does he think is going to happen? So great chat with Matthew.
Yeah, Matthew's interviews are the kind of thing that all you need to do is sit there with a pad of paper and a pen, and he just take notes. Like he just knows so much about so many different things, and you both cover so many different topics during an interview, and it only goes for 10 or 11 minutes, and you will learn more in that than, well, pretty much whatever else you do today.
Matthew's been is a very successful fund manager, but prior to getting into funds management, he actually was a journalist and one of my very first colleagues at the Sydney Morning Herald, and such a calm character. No matter what's going on around him, Matthew is calm.
Yeah. Great communicator. Well worth a listen. It is coming up later in the playlist. Sean, we are talking about markets. Where did things finish up on Friday?
By the close, the S&P ASX 200 was up slightly to 8,212 points, and for the week, the bourse was flat, though that hides the fact that those mining companies did really well and the banks have fallen back. In corporate news on Friday, Endeavour Group Chief Executive Steve Donohue, been with the company 30 years, 6 years as CEO, he stepped down. In response, the liquor retailer's share price fell 3%. Also, the competition regulator, the Australian Competition Consumer Commission, said it remains concerned about the proposed acquisition of Nemoy Cotton by Olam Agri Holdings. Olam is a Singapore-based group because the multiple linkages between Olam and Louis Dreyfus Company, which is another one of the big cotton players. So we'll also have to see how that takeover goes.
All right, thanks to Blue Chip Communication, the experts helping financial services companies market, communicate and grow. Visit bluechipcommunication.com.au. Give us an overview of what's happening internationally, please, Sean.
The big news this week is that the US Federal Reserve Chair Jerome Powell is speaking tomorrow morning Australian time. Everyone wants to know if the world's most important central bank is thinking about cutting interest rates again. There are also jobs figures out in the US later in the week. I mentioned that about half the world's central banks have started cutting interest rates, but not Australia. Michael, you will be pleased to know some very important central bank meetings this week.
Why do I get the feeling that you are being slightly sarcastic here?
Well, to be honest, the people in these countries, it is extremely important to them. Maybe less important to us. So let me run through the central banks. Iceland, Colombia, Dominican Republic, Poland, Romania, Tanzania, Mozambique. I'd like to say we'll keep you updated on all of those, but I dare say we won't ever mention them again.
Well, I love the fact that after last week, when Reserve Bank Governor Michelle Bullock was at pains to point out that really it doesn't matter what anyone else does around the world, we are running our own race here in Australia. So really, what happens in the Dominican Republic is probably going to have very, very, very minimal bearing on us.
Oh, I don't know. I mean, I think we have to do a bit of research on that.
Yeah, that could be your research for this week, Sean. Okay. I'm not volunteering for that one.
In terms of the numbers, oil's trading just under $72 a barrel. Gold is fetching $26.58 an ounce. Bitcoin is worth almost $66,000 a unit. It's done pretty well the past week or so. And as I mentioned before, the Aussie dollar is buying just over 69 US cents.
All right, we have a fair bit to cover, Sean. We'll be back in a moment with the rest of the day's business news. Sean, it was grand final weekend in Melbourne, and that severely reduced the number of home auctions over the past week. Having said that, the preliminary clearance rate across the nation tumbled to 64.5%.
One weekend does not make a spring, or something like that. But
it's not a saying.
No, it's not. Was it one swallow does not make a summer?
I don't know. You've actually used that saying a couple of times, and it feels like a saying from a generation that has passed us by.
Totally. And my father used to say it, to be honest.
But you know what? We'll bring it back.
So that 64.5% was the lowest number, the preliminary clearance rate, since December last year. The final clearance rate for the previous week was just 60.7%. It was also the lowest in 2024, according to CoreLogic. 1,200 homes went under the hammer in Sydney. Its clearance rate went from 70.3% last week to 66.1%. That's probably the best indicator, given it was less affected by the AFL Grand Final. There are only 237 auctions in Melbourne. Preliminary clearance rate of just 56.7%. We can probably just ignore that one because of the football. Adelaide came in at 74.6%, Brisbane 55%, the ACT just under 66%. I mean, you probably can ignore the weekend's figures, and there's obviously an NRL final in Sydney next week. Not that affects housing anywhere near like the AFL does. It's just... Well, I mean, I don't want to overstate it. It's just going to be very interesting to see what happens in the housing market the next few weeks. It just feels like it's cooling quite a bit, which is probably good for house buyers, not so much sellers.
Now, the competition regulator has published its interim report for its supermarkets inquiry, a report that outlines what the ACCC has heard from interest groups.
It says that supermarket retailing in Australia is an oligopoly, with Woolies and Coles accounting for 67% of supermarket retail sales nationally. Aldi's at about 9%, Metcash is about 7%. It says that oligopolistic market structures can limit incentives to compete vigorously on price. Now, Deputy Chair Mick Kerr said Woolies and Coles offer broadly similar experiences to customers, undifferentiated product ranges largely, prices at similar levels, similar non-price offerings, including loyalty programs. The report says that food price growth is largely in line with inflation over the past 5 years, up 20% over that period. Consumers are increasingly comparing prices online before buying. They actually struggle to compare products and are losing trust in sale price claims by supermarkets. No surprises after what we heard last week. Meanwhile, many grocery suppliers have told the ACCC that they consider that they sometimes receive prices below the cost of production and have little choice but to agree to highly unfavourable terms, with these terms being subject to ongoing changes by the major retailers.
67%. Does that seem low to you?
Yes, so I was trying to work that out. I agree. So 67 plus 9% for Aldi, what's that give us? 76.
Mm-hmm.
Matt Cash is another 7, so we're at 83%. I figured that 17%, it's probably a huge amount of very small retailers. So 7-Eleven would be an example of that.
Yep.
And
you could probably toss Costco in there.
That's true. So they're not so small, they're really big.
Yeah.
So,
but just not so many of them, though, around the country.
Yeah. But there would be a lot of smaller, kind of almost corner store style.
Yeah, convenience.
Yeah. Convenience stores, yeah.
Yeah, and I suppose maybe to kind of greengrocers, that kind of thing come into that probably as well.
Yeah, there's a bit of an argument at the moment about how you capture the supermarket sector. And so you could argue that there are groups like Bunnings, which is actually starting to offer, particularly as they move into pet food and things like that.
Yes.
Yeah, they are starting to offer a lot of supermarket products. Now, of course, they do not want to be known as supermarkets. But there's an argument to suggest that, well, you're offering a lot of supermarket products.
Great insights today, Sean.
There you go.
Anyway, moving on. The biggest super funds are getting even bigger. I mentioned this at the top of the show with Australian Super and Australian Retirement Trust now accounting for more than half of all new retirement savings and more than $655 billion in assets.
Yeah, they are massive. So they're the top 2. The next 5 largest industry super funds, UniSuper, Hostplus, Cbus, Rest and Hester, manage $700 billion. That's about, it's a little bit more, but not a lot more, 10% more than what those big 2 manage. And the gap between the top 2 and the rest is growing. The growth in the 2 mega funds is not necessarily a good thing because it could trigger all sorts of governance issues and just challenges finding places to actually put the money. That's according to analysts at Morningstar. Australian Super now manages $341 billion in retirement savings alone, with Australian Retirement Trust managing $314 billion, according to the Australian Financial Review. Aware Super follows on $180 billion. Separate figures compiled by Morningstar show Aussie Super received 37% of inflows. That's with less withdrawals. In the 12 months to the end of June 2023, Australian Retirement Trust accounted for 15%. These funds are just massive and they're getting bigger, and there's a problem with that.
Interested to get your thoughts on this one, Sean. The Financial Review's annual list of the 10 most powerful business leaders. Topping the list is Commonwealth Bank boss Matt Comyn.
Yeah, so Matt Comyn's done a great job deflating the anger around banks and has increasingly grown his brief, speaking out on everything from intergenerational inequity and artificial intelligence to housing and tax policy. Number 2 on the list, and this refers back to our previous story, was Mark Delaney, the Chief Investment Officer of Aussie Super. Aussie Super is powerful as demonstrated by its scuppering of the Origin Energy deal last year, according to the Fin. Basically, nothing big happens on the ASX without Aussie Super knowing about it. Next on the list is BHP CEO Mike Henry, then Hester's boss Debbie Blakey, followed by Gina Reinhart and Andrew Forrest.
And Star Entertainment began trading again on Friday, the first time since the end of August, having finally published its 2024 financial year accounts, which showed a $1.7 billion loss. And Sean, it wasn't pretty.
It wasn't pretty. Star's share price lost 50% on opening before finishing down more than 40%. The company is now worth $1.3 billion, whereas at the end of July, its market cap was around, somewhere between $3 and $3.5 billion. Under a finance package secured last week, the Star will have access to $200 million in 2 tranches of $100 million each. The first will be available subject to conditions later this week, but the interest rate on it is very, very high, 13.5%. Last week, the gaming group also failed to do a deal with the Queensland government over tax relief. A lot of work for management.
Okay, turning to international news now, Sean, and Israel has killed Hezbollah's leader Hassan Nasrallah in a massive strike on Beirut, in the latest in a series of blows to the Lebanese militant group.
The strike in a densely populated residential neighbourhood in southern Beirut was part of an intense bombardment carried out by Israel forces and marked a dramatic escalation of Israel's offensive against Hezbollah, according to the Financial Times. The Lebanese group confirmed Nasrallah's death, saying he had joined the group's long list of martyrs. It said its leadership would continue to battle against Israel in support of Gaza and Palestine and in defence of Lebanon and its steadfast and honourable people. Israeli Prime Minister Benjamin Netanyahu said that Nasrallah's killing was a necessary step toward achieving the goals that Israel has set, including changing the balance of power in the region for years to come. Unfortunately, the conflict in the region is escalating, not deflating.
Indeed. Now, the first new kind of treatment for schizophrenia patients in decades has just been approved by the US Food and Drug Administration.
The new class of treatments could help stabilise patients' symptoms without the uncomfortable side effects that accompany existing antipsychotics. The side effects have always been the big issue with many of these antipsychotic drugs. The new drug, called Cobenfy, works differently than the class of drugs used by many to treat schizophrenia. According to the Wall Street Journal, the Bristol-Myers Squibb drug works by mobilising a new target in the brain. Traditional antipsychotic drugs have side effects including weight gain, falling asleep, involuntary muscle jerking. The new drug, though, is not without its own side effects. Participants in clinical trials reported higher levels of nausea, vomiting, and constipation than in the placebo group. Notwithstanding that, very, very encouraging news that after many decades, there's a breakthrough in treatment for schizophrenia.
Sean, up next is Fear and Greed, the week ahead, featuring our resident economist, Stephen Koukoulas.
Yes, I have a great chat with Stephen. Not the biggest week for data, but lots of little bits and pieces, trade and building approvals and retail trade. And they're the sorts of information that the kook loves. He can kind of break them apart and think, oh, this is happening, that's happening. And we had all the excitement of inflation and Reserve Bank last week. I think the kook needs just a little bit of, bread and butter style economic data this week, Michael.
And he explains it all so well. So that is coming up next. And speaking of explaining things well, stick around then after that for your daily interview featuring Matthew Kidman.
He starts off by talking his words, the great rotation out of banks into miners. And that's what we talk about.
Yeah, so plenty of good listening coming up in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, which is where you can sign up for our free weekly newsletter. It comes out midweek, so do it today, and then you don't have to think about it ever again. It'll just land in your inbox mid-Wednesday morning. Thank you very much, Sean.
Thank you, Michael.
It is Monday, the 30th of September, 2024. Make sure you're following the podcast, and please join us online on LinkedIn, Instagram, X, TikTok, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.